I would say it's good to be invested. I would say conservative is probably a good way to play it, just to see how everything works out. I would say on the short end, there are opportunities. So for example, the 0 to 1 year part of the curve still looks fairly attractive. If we have rates coming down within the credit world, yes, it's likely there will be some widening. And within high quality benchmarks, there could be some fairly opportunistic entry points coming up. It's tricky to call exactly when the widest points are, but I think we're going to have a bit of volatility in the next months ahead. That's for sure.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner. Hi, would you please introduce yourself for the audience of Geldmeisterin? Welcome here on the podcast.
Yes, thank you, Julia, for having me. It's a pleasure to be here. My first time on the podcast. My name is Raphael Stern. I manage the global portfolio management team at Invesco for anything that really has an index. So ETFs, index strategies, mandates. That's what I look after. Our team manages about 110 different fixed income ETFs globally. So it's quite a vast operation and task to manage these portfolios on a daily basis.
Yeah, and this is a really tough time right now of index trackers. So how would you see the situation right now?
Yeah, I mean, obviously, so today there's a lot of volatility in the markets. I think that's for sure. If you look at technicals, we have the VIX spiking again to close to year-to-date highs. We have the MOVE index, which is a measure of how volatile the treasury rates are, going above 100. Sovereign bonds are definitely in the risk-off mode. Equities are down 2 to 3%. Credit spreads are blowing out. So I guess there's plenty of reasons to worry, but I would say from what we've seen so far in the markets, there's no element of panic selling. So I think it's a reaction of uncertainty and volatility at the moment, but we haven't seen very large outflows so far.
Mm-hmm. And does the volatility and uncertainty hits the bond market more than the share market, or how would you see that?
Yeah, so I think it depends. Over the last few years, I think correlations probably were positive. Actually, as of today, the equity market and fixed income market correlations are negative again. So the equity markets are definitely more volatile. If you think of it from a traditional asset allocation perspective, kind of the 60-40 between equity and fixed income, investors buy fixed income to lower their volatility. They buy fixed income due to the low correlations to the equity markets, and it's generally a risk reduction trade. Now, obviously, we've had fairly attractive yields in the fixed income market. So I think it's a mix of income and low correlations and diversification. And that's why the majority of investors are looking at fixed income.
So you should see a lot of inflows right now where everything is so uncertain in the capital markets.
For the last 12 months rolling, we have seen flows into lower risk parts of fixed income. So money markets, a short end of sovereign curves, short end of credit curves. The flows have been, so to put it into perspective, March has been very volatile. So we haven't seen flows really added to fixed income, but February was the second highest NNA, net new asset month ever in the UCITS fixed income ETF market. So we've had about 14 billion of net new assets into fixed income year to date. And I think that's a number that will very likely continue to increase given the volatility that's caused by the tariff announcement that's now working through the markets.
It's now or never. And do you think it's now too late already, since, for example, Warren Buffett owns more bonds than shares at the moment? So is it a good timing to invest now in bonds, and which kind of bonds? And I know in timing is never good. It's better to be long time in, but does bonds now belong to the portfolio, even if you don't have them already and you're just in shares right now?
Yeah, I think you're absolutely right. It's very difficult to time the market. So from an investor standpoint, it probably makes sense to buy a little bit regularly. That's generally how Warren Buffett would probably explain it from an index perspective. And yes, you're right. He's, I believe, the largest holder in U.S. Treasury bills, so the very short end paper. I think 300 plus billion of holdings. I think that indicates that cash right now has an attractive yield relative to the risk on offer. I do think the general consensus is that spreads will go wider from here. Mm-hmm. So in terms of credit spreads, there are, I guess the R word is going to be mentioned more often, the recession word, which could mean spreads widening more. There may be more attractive entry points, but that doesn't mean being in cash or in the short end sovereign or credit curves is not a safe place to be at this point.
Mm-hmm. And who loses, who wins from the widening of the spreads?
I guess it depends. If you're a holder already and you have a short time horizon and you may have to liquidate your holdings soon to raise cash or whatever your investment needs are, you would sell at a lower price. Mm. If you are opportunistically sitting on the sidelines today and you've been waiting for an entry point, you will get paid a higher yield at current levels and probably over the next few weeks and months, maybe even more attractive levels. So then you could be a winner from that perspective.
And what kind of bonds do you prefer right now? I think the debts of many states are exploding. Isn't it already more safer to invest in corporate bonds?
Yeah, it's an interesting one because there's obviously there's a lot of debt levels that are increasing. As we have Germany, for example, expected to spend, I think, about $1 trillion plus over the next few years on defense and infrastructure spending. So that will increase it could increase sovereign spreads. Now, generally, corporates of the sovereign are correlated to what the underlying sovereign is doing. So if German sovereign spreads are widening, generally speaking, German corporate spreads are also widening. So there's a positive correlation there. Having said that, I think investors aren't generally worried about the size of the debt increase. So let's say in the case of Germany, if over the next 5 years we had zero growth and this massive defense spending is pushed through, debt to GDP will go from 60 to 80 or 90%, but that's relatively still low compared to other countries, France, Spain, Italy. I don't think anyone's worried about that. It's more, I guess, tariffs, uncertainty of growth. That's really what investors are mostly worried about. Mm-hmm. I need a dollar,
that's what I need. But still, if you're a bond investor, don't you have to be also worried about the currency? Since right now, for example, Germany is really important to have a strong euro. But if they also make higher debt, then the euro should lose again. Or how is your expectation then? And on the other hand, also the USA, if they get into the recession and they have even more debt, there you also have to think of the US dollar if nobody trusts the US dollar as tough currency anymore.
Yeah, and I mean that's $1 billion question. And it's really difficult to have a crystal ball and say concretely this will happen because it's all relative. So As things stand right now, I would say investors are expecting the dollar to weaken, the euro to strengthen. That's kind of our firm view at the moment. It will depend on the effects of, for example, in the terms of the dollar, what's the impact of the tariffs on inflation? What's the impact on the broader economy? And kind of this tug of war will play out on how strong the dollar is relative to other currencies. I think based on what we know now, which I think we're at probably close to peak uncertainty, the market seems to expect the dollar to weaken, and the euro is a fairly good place to be.
That means also a fairly good place to be in euro bonds?
Yes, I would say so. I mean, the performance of euro sovereign bonds year to date is positive, although not massively positive, but it is in the green. The expectation that the spending obviously will increase debt levels, but I think the growth increase that will come from that will offset most of that to a degree. And obviously from an independence perspective, you could argue that being in control of your own destiny, so to speak, is probably a net positive for the EU as a whole. And I think there will be some countries within that are probably going to benefit more than others. But net, I would say it's a fairly safe place to be.
Mm-hmm. And as you said, one is better than the other country. Which one do you prefer? Do you prefer more the southern European countries or still more the Germany or the German-speaking area?
I think we'll have to see what spending packages are actually passed and implemented. There's a lot of defense industries in the UK and Italy and Germany. Yeah. France has a large defense industry. So there's kind of the core European countries, ex-UK, of course, definitely could benefit from the growth that comes from the spending package. Mm-hmm. But that's not saying that some of the peripheral countries cannot benefit from that as well.
Mm-hmm. And if you say, if I get you right, you should diversify as a shareholder in bonds. Why should I invest in fixed income ETFs? Since I don't get it. If I buy a bond, a single bond, I can say I get this and this as interest. But if you have a bond, how can you be sure what you get out or what chocolate bar you are buying?
Yeah, it's a good point. So I guess I can explain it with an example. So why individual bonds versus fixed income ETFs essentially is what I'm trying to explain. So the first one would be, what exactly are you after? So let's say you own an OMV group bond with a 3-year maturity. Why do you own that particular bond? Like, do you have a strong view on OMV, or is it the oil and gas sector that you like, or is it maybe Austrian corporates that you like? With an individual bond, you're essentially concentrating your risk. So you have high idiosyncratic risk that comes with bond picking. That means, for example, what if that bond I explained doesn't get called? Let's say it misses the call date, it gets an extension of 5 years. Now, all of a sudden, you as a bondholder have an extension risk. You don't get your principal back for, let's say, an extra 5 years. So my point is, individual bond picking is rarely the best solution. If you're solving for income needs and have certain views on interest rate risk, you can solve for both in a diversified way by picking the right ETF. So this will certainly be the more liquid approach. So if you own an ETF versus single bonds, you benefit from the scale of the ETF itself. Mm-hmm. You benefit from other investors that are part of the same portfolio. So if you think of trading a concentrated position in an individual bond, you're in a sense hostage to getting a good price when you try and enter and exit from that specific position. Depends who you can trade with, what the liquidity is of that bond on that day. If you're an ETF, you're really exposed to a basket of securities, and that's driven by what's in the index. So you access the scale, you access more liquidity, and also the ETF itself has what we call primary and secondary liquidity element. Mm-hmm. So, for example, the shares of the ETF, they trade themselves. So market makers can buy and sell the shares of the ETF. No bonds actually need to exchange hands. And the majority of the volume in fixed income ETFs can be absorbed via this sense of ETF shares trading. So one investor is buying the same ETF, another one is selling it. There's kind of this offsetting or netting of positions. That's one of the efficiencies that ETFs bring, which you don't have trading individual bonds. And I think the tools available to investors in individual bonds versus ETFs, so the ETF universe has increased quite a bit. So the options available to investors in putting specific positions on via ETFs, that's become really good. So for example, if you want to buy 2027 maturity Euro corporate bond ETF, you can now do that.
Okay.
So you have access to a basket of 400 bonds that are in that index. You don't need to worry about finding which bonds you like and trading them individually in small size. You can buy one ETF and get specific exposure that way.
But still, I love my ETFs. The core investment in shares is in ETFs, but I'm still a little bit cautious what bonds, because how do these ETF pick the bonds? I mean, it can't be that the bigger depth means there's more of this company in my portfolio.
Yes, you're absolutely right. And basically, so what you're describing is a market-weighted index. Any company that has the most debt will be the highest percentage in that index. And then essentially what you're explaining is the investor who buys that index has the most exposure to the most indebted company. Now, there are ways to get around that in quite smart ways. So the way benchmarks are designed is critical. So not all ETFs are equal. Not all benchmarks are equal. So, for example, you could have a benchmark rule that limits the exposure for each issuer at 3%. Or at 8%, whatever makes sense from a particular market that you're looking at. So that will really help increase or decrease the idiosyncratic risk. So you diversify your issuer concentration. And also, quite often, the index rules have a minimum size outstanding rule per bond. So let's say in the Euro corporate space, you may not want to buy bonds that have less than 300 million outstanding per bond. So if you include a rule in the index that excludes anything below that, you're essentially controlling for the least liquid tail of the index. And that means the ETF will be more liquid by not having to buy those smaller bonds that don't qualify.
Okay, so you have to look at the fact sheets even more than in stock ETFs.
I mean, the principle is the same. On the share side, you also have concentration risk. You need to know how much weight is in emerging markets. For example, is the volume per day that you trade in those smaller markets acceptable or not? Similar ideas apply to fixed income. There are just slightly different factors that you control for.
And is it better to buy single bond ETF or mutual fund?
Yeah, so the mutual fund versus ETF wrapper discussion, that's definitely a big one. And I think that the flows have been fairly clear on where the investors' preference is. So over the last 5 to 10 years, we've really seen a shift from mutual fund wrapper to ETF wrapper. And there's a few reasons behind that. One is that the ETF wrapper it's really a newer technology. So with the ETF wrapper, you get intraday liquidity. If you buy a mutual fund, you just get one NAV per day. So you can't buy and sell during the trading day, which means you don't know where it's trading. So there's a benefit to that from investors that, want to have a sense of what's their portfolio holding at midday, let's say. You can do that in an ETF. And then also this concept of primary and secondary liquidity. So the mutual fund, if you're a portfolio manager in a mutual fund, you get your cash flow once a day and you either buy or sell positions. In an ETF, we have we have some cutoffs, but a market maker who prices our ETF, they can come to us as an issuer, as a portfolio manager, multiple times throughout the day. So if they have let's say they sell a large position to a client in our ETF, they can come to us as Invesco and say, look, I would like to exchange either cash for shares of the ETF, and this could be at 9 a.m, or quite often what happens is a market maker has access to a large inventory of bonds, and they ask us, can I please exchange a basket of bonds versus shares of the ETF? And then we try and work with this market maker to use the bonds that they already have on their inventory, and we exchange for a number of shares of an ETF. And that really reduces the cost of the market maker to create an ETF. And that's just not possible in an ETF, in a mutual fund structure. And I think that's why, from a flexibility standpoint, this cash and in-kind creation process really benefits the ETF.
Mm-hmm. And you just mentioned it, that there's a variety of bond ETFs already. You can buy any duration, more or less. And for at least in Austria, the term funds are very popular. Do you see them as a solution, or isn't this quite costly to manage?
Yes, so term funds, target maturity funds, whatever you want to call it, they have had about close to 10 billion of net new assets over the last year in UCITS alone. They are very popular investment vehicles, and essentially what a term fund means, or a target maturity ETF, is, like I explained in the earlier OMV example, it's, let's say, Euro corporate bond that has a 2027 maturity, and it kind of functions like a bond. So you buy this ETF, 2027 maturity, it pays quarterly distributions, and it rolls towards maturity as we get to 2027. So in December 2027, you get your principal and coupons back. Mm-hmm. That's very similar to an individual bond, but unlike an individual bond, you have exposure to 400 to 500 bonds, all that have to qualify into the index. So they have to be investment grade. In this example, they have to be above the minimum size outstanding. So you kind of control for minimum liquidity in this basket, and you have diversification. So from a liquidity standpoint, it's extremely efficient. So for our PMs that manage these type of ETFs, we have ability to sample any one of the 400 to 500 bonds in that index. We can make sure and sample a particular sector or subsector, and that gives us flexibility, versus if we had really high conviction on one specific bond, or maybe a handful of bonds, there could still be a credit risk on any of them, and then you would have very meaningful idiosyncratic risk and potential downside. And also from a managing the duration perspective, if you can with one trade own 400 bonds with that exact maturity, it's very easy to sell that and maybe buy a longer one. But if you do that with bonds individually, that's quite expensive, and it will take quite a lot of time too. So
did I get it right? You are not really a friend of term funds, or it depends what you want?
We like these target maturity ETFs quite a lot. Mm-hmm. We see investors using them, and they are building blocks for many type of investors. So it could be retail investors who buy these target maturity funds. Let's say you have a daughter in university, and in 2 years, you have some expenses that are coming up, and you want to put that into a safe place to invest, but earn a bit of yield on top of just money sitting in the bank. So that's kind of one specific liability matching exercise that individual investors can do. But we see a lot of really sophisticated institutional investors who are, for example, they have an active portfolio of individual bonds. Maybe their tactical view on duration changed, and they want to lower the duration without having to sell a lot of bonds because they like the bonds that they own. So they can do an overlay and buy, let's say, a 1 or 2 year duration Euro corporate target maturity ETF to lower the portfolio duration. And you could have kind of laddering of duration, barbells. It's really quite a wide variety of use cases.
So there are two opportunities with these term funds or the maturity funds, that you can mix your duration exactly as you want. And the other thing is that it's like to have one bond with a fixed maturity, so you can plan better the outcome at the end.
You're exactly right.
Okay.
this will be indeed the golden age of America. It's coming back. We're going to come back very strongly.
How did your horizon for bond investing or for the ETFs change with Donald Trump?
Yeah, it's a tough question. There's so much going on in the markets, obviously. So we had this big announcement on so-called Liberation Day yesterday. Markets in the US are really just opening still. So what we can see so far, I'd say there is widening. There is some weakness across markets. So equities are down. In Asia, close down about 3%. Europe's 2 to 3% down. And futures are opening down about similar areas in the US at the moment. From a credit perspective, spreads are widening anywhere from 5 to 10% in investment grade, but there isn't much volume flowing through yet. So I think the commentary that we're seeing from some of the big banks that we speak with is that there's definitely some softness in the market, but no panic selling. Mm-hmm. And I think it's going to take a bit of time for clarity to come out of this big announcement. There's obviously going to be reactions country by country or union by union, which will trigger potentially additional escalation or hopefully a de-escalation. But it's going to be fairly case by case. And it's a very tricky time for investors to completely make the perfect decisions with so many factors. And for example, if uncertainty increases, if the economy starts to slow down, that means probably the central banks have to cut rates. And actually, the probability of rate cuts has increased since yesterday. We're looking at about 75 basis points of cuts across the US, the Bank of England, and the ECB by year end. In generally, that can be positive from a total return perspective, because you may have widening of spreads, but if the underlying rates are coming down, that could be positive. So I think it really depends where are you positioning and what actually transpires between now and year end.
Okay. So as a retailer, you should stay on the sideline, even though being time in the market is better than timing the market?
I would say it's good to be invested. I would say conservative is probably a good way to play it, just to see how everything works out. I would say on the short end, there are opportunities. So for example, the 0 to 1 year part of the curve, whether it's in euros or in dollars, still looks fairly attractive. If we have rates coming down, generally that's kind of it's the 2 year part of the curve that benefits the most from that. So having a bit of exposure on the short end on sovereign curves could be a fairly safe place to be. Within the credit world, yes, it's likely there will be some widening. And within high quality issuers, high quality benchmarks, there could be some fairly opportunistic entry points coming up. It's tricky to call exactly when the widest points are, but I think we're going to have a bit of volatility in the next months ahead. That's for sure.
Mm-hmm. And there's also the danger of a recession in the United States. So which bond investments could be more, which would be less affected by a possible recession in 2025?
So if there's a recession coming, generally you want to be in higher quality parts of the fixed income market. So investment grade, for example, could be a good place to be. TIPS are one of these asset classes, so inflation protected securities. We've actually seen, so going into end of 24, we've seen outflows in TIPS in the US. Since 2025, we've had inflows every single week. Total return of TIPS is the highest out of any subcategory within fixed income, so almost up 4% total return. So I think it's clear that investors are expecting inflation to increase. There's many metrics of measuring that. For example, the 5-year break-even rate is up to about 2.6 last time I checked. So that's an expectation of average inflation over 5 years in 5 years. So it's a gauge of where do investors expect inflation to be around. And if that plays out, I would say tips are probably still a conservative way to play it, but a lot of it is priced in already.
Yeah.
So it's a question of, when do you buy it? When do you get exposure? And is there anything that's not priced in yet?
That's the case because inflation-linked bonds are really difficult to price for the retailer because he doesn't know what's the exact right inflation rate expectation which is priced in these products. So
yes, I would recommend with tip securities, look at an ETF, and there's different types of ETFs where you have shorter end exposure or just a full curve and benefit from the scale that ETF offers, and you will probably get the best pricing that way.
Mm-hmm. And finally, do you think Warren Buffett did the right thing to be more invested right now in bonds than in shares?
He's just one of the smartest investors on the planet. So I cannot speak negatively about Warren Buffett. He has $300 billion plus of cash ready to deploy. My assumption is that he's been waiting for turbulent times for years, and he's waiting to invest that cash at the right valuation. So I would say he's done very well by being in bills over the last few years.
Thank you very much, Robert, for your time and expertise. And I wish you all and wish us all luck at the turbulences at the markets at the moment.
Thanks very much, Julia. It's been a pleasure.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.